mortgage rates are up again.
Again, the 30-year fixed rate surpassed 5% this week. Freddie Mac says rates jumped to 5.2% from 4.9% last week. Now, while rates remain lower than June's 5.8%, the hike is still discouraging.
Rising interest rates have people looking for ways to lower their potential mortgage payments. Of course, adjustable rate mortgages are one vehicle that they're turning to.
So joining us for more on this is Greg McBride. He's the chief financial analyst for the finance website bankrate.com. Greg, so great to see you. So, you know, when we hear the word adjustable rate mortgages, I can't help but think back to 2008. All kinds of bad memories come flushing forward. So can you explain how they work and how they are better now than they used to be, hopefully?
There are a lot of borrowers and a lot of lenders that have that fresh memory as well. And so that's why even at a time like this, we're still seeing only about 8% of borrowers are actually applying for adjustable rate mortgages. So very small share. You know, the height of the 2004 to 2006 credit boom, it was more like half. So much different universe now than then. Qualification standards are much different too. So really an apples and oranges comparison. The way these work, you start out with a fixed interest rate. It may be good for a few years, 3, 5, 7 years, and then it becomes adjustable. But what it becomes adjustable to depends on where interest rates are at that point in the future. So a lot of uncertainty, and that's where the risk comes in. You could face potentially higher payments in years to come at a time when you may not be able to afford it.
And following on, Tanya's concerns, could this renewed interest in, trigger another mortgage meltdown? Going back to, how it's different, appeasing people's fears, or should people be cautious?
I think there's always room for caution on the part of the borrower. Do not look to one of these loans as a crutch of affordability. The 30-year fixed rate mortgage, it may not be the optimal loan in every single case, but it is your best gauge of affordability. If you can't afford the house on a 30-year fixed rate mortgage, you can't afford the house. It's not a matter of finding a different loan. You got to find a different house. So the qualification standards, fortunately, much, much tighter now than in years past. So you do have to qualify for a much higher monthly payment than what the initial low rate is on that adjustable rate mortgage. And that's going to prevent a lot of people from getting in over their heads and getting blindsided by higher payments, which was really the recipe for disaster back in 2007 and 2008.
Greg, it's really hard for me to see any upside to the adjustable rate mortgage. Can you give us an example of the type of buyer who might benefit from one of these?
Yeah, I mean, these are primarily the domain of higher net worth, higher income borrowers, those, for example, whose income might be very lumpy. Maybe they're paid with large commissions or a lot of incentive compensation. And so they like the ability to make different size payments as their cash flow permits. As far as main borrowers are concerned, where it can be a good use is, let's say you're buying a home, it's going to be a starter home. You know you're not going to be there more than 7 or 8 years. You take a 7-year adjustable rate. You have a fixed rate for that 7 years before it becomes adjustable. Your timetable pans out. It essentially functions like a fixed rate loan, but at a lower rate and lower monthly payment than if you had taken a fixed rate loan.
That's a good point, though, if you plan to sell your house in 7 years.
I mean, you say that like there's a lot of options for getting a starter home. It's we live in a housing climate that
it's rough out there.
It's extremely rough. If you can even buy a home and not, rent beyond your means, sure. Greg McBride, thank you so much for the wisdom and insight.
Thank you.